Welcome back to Easy Finance. In today's video, we will talk about depreciation, a fundamental concept in accounting that every student should understand. So, let's get started. So, what exactly is depreciation? When a company buys a long-term asset like a building, a machine, or a car, it doesn't make sense to record the entire cost as an expense immediately. Why? Because the asset will be useful for many years, not just in the year of purchase. Depreciation is the process of systematically allocating the cost of that asset over its useful life. This way, the expense of using the asset is matched with the revenue it helps generate. For example, if a company buys a delivery van for 20k and expects to use it for 5 years, we don't expense 20k in the first year. Instead, we spread the cost over the 5 years through depreciation. Depreciation appears on the income statement as an expense and reduces the profit, while on the balance sheet it reduces the book value of the asset through something called accumulated depreciation. Now that we know what depreciation is and why we need it, let's go through the main methods. The most widely used and simplest method is the straight line method. Here, the depreciation expense is the same every year. The formula is depreciation equals cost minus residual value divided by the useful life. Suppose we buy a machine for $10,000 with a residual value of $2,000 and a useful life of 4 years. Then our annual depreciation is 10,000 divided by 2 equals 8,000 divided by 4. So in the end we have 2,000 per year. Easy to calculate and easy to understand. The second method is a declining balance method, which is an accelerated method. That means depreciation is higher in the early years and smaller later on. The most common version is the double declining method. The formula here is the depreciation equals the beginning book value times bracket open 2 divided by useful life bracket closed. So expect the same machine as in example 1 with $10,000 cost and 4 years of life. In the first year, we have the $10,000 times 50% equals an annual depreciation of $5,000. In the second year, we have the new book value, so 10,000 minus 5,000, so the new book value is 5,000. So we multiply it again with 50%, so the depreciation for the second year is 2,500. And so on for every year. This method reflects how many assets lose value more quickly when they're new, like cars or technology. The third method is the units of production method, and this is activity based. So the depreciation depends on how much the asset is actually used, not just time. Here, the depreciation per unit equals bracket open cost minus residual value bracket closed divided by total units. If the machine costs $10,000, residual value is $2,000 and it's expected to produce 40,000 units. Depreciation per unit so on is bracket open 10,000 minus 2,000 bracket closed divided by 40,000 equals $0.2 per unit. If the machine produces 10,000 units in the first year and we multiply the 10,000 by the $0.2 per unit, the depreciation for the first year would be $2,000. This method is, for example, perfect for the manufacturing equipment. Depreciation spread the cost of long-term assets over their useful life. Straight line is simple and spreads cost evenly. The declining balance is accelerated and better for assets that lose value quickly, like technology or cars. The units of production links depreciation to actual usage. So good in production. That's depreciation in a nutshell. In upcoming videos we will take each method and go step by step through detailed examples and practice problems. So make sure to subscribe if you want to master this topic for your exams. If you found this video helpful, make sure to like the video, leave a comment with your question and subscribe to Easy Finance so you don't miss the detailed breakdowns of each method in the next videos. Thanks for watching and bye bye!